Look at Carnival, though. Shares are getting crushed today, losing nearly a fifth of their value. The company missing street estimates on revenue. It also said inflation and rising fuel costs are delaying a return to profitability. The stock hitting a 30-year low. The three major cruise operators are some of the worst performers right now in the S&P. Let's bring in Jefferies analyst David Katz. He's on hold on Carnival, $12 price target. What happened here, David? This is supposed to be the big rebound.
They did miss on revenue, as you pointed out, Sarah. They came in high on the cost side as well. But I think more importantly, the street had been taking the view that they could exceed 2019 EBITDA by 2023. And they walked that back on the call this morning. And I think that aspect of it is probably the biggest driver. What is the trajectory of this recovery going to look like? And the most important aspect of our thesis has been that Carnival and cruise in general does not have the pricing power that we're seeing elsewhere in hospitality, right? Where room rates are high, the cost of things, they're just not able to embed that inflation the way others are because their patrons are a value-driven customer. And so they bundle and do other things, but they're just not getting it, Sarah.
I was going to ask why. So the value-driven customer, part of the reason, but because, we've had, and I know Arnold's not there anymore, but we had him on so many times, and he kept saying, once these restrictions ease, once the CDC lifts its guidelines, and now they can, you don't have to be vaccinated, right, to go on a cruise. The demand is there. The forward bookings are strong. Is that not the case?
It is the case. I think part of what hit them today and what will hit them again in the fourth quarter is they had some carry forward credits that worked into pricing and brought the ticket pricing way down below what we were expecting. And frankly, they've not been particularly good guiders, or particularly open guiders over the years. And I think that attribute, this is not the day to be like that. I think we need a little bit more information flow and just more comfort with where our numbers are. We're still working through our model today, post the filing coming out. But we have some homework to do and try and figure out what 2023 is going to look like and, potentially what 2024 could look like in this environment.
So when now do you expect profitability, and how's the liquidity position until then?
Right. So we do expect that they will be in positive EBITDA territory in 2023. And where that exactly lands, is fine. They have ample liquidity for the moment. They did a $1 billion equity offering back in July at $9.95. So they have enough cash. People have been asking, can they survive? And we believe that they can in some semblance of a normal 2023. Frankly, it's just not an easy stock to buy today because you need to have a cohesive consensus. You need to have a sense of what 4Q is going to look like. And if they're not going to get to that 2019 benchmark by 2023, we need to know how far off they're going to be and what that trajectory really looks like. And until then, establishing value is hard.
It's a tricky one. Thank you, David. Appreciate the commentary. David Katz.